Today we're going to continue with the accounting cycle, and we're going to talk about something called adjusting entries. But first, let's talk about some of the principles from this chapter. The first one is called the matching principle. And this requires that accountants or businesses match up the revenue that comes in with the expenses that are incurred as a result of that revenue. Okay, matching the revenue with the associated expenses. It provides the best measure of net income and truly reflects properly on your financial statements. So let's think about this for a minute. Why would you have this so-called matching principle? So that the revenue coming in matches the expenses. Otherwise, what would happen is you may record your revenue and then not record your expenses because you're not paying them till later, after the fact, show someone an income statement that looks like you made more money than you actually did. And what could that cause? Maybe someone to invest that would normally have done so if they had seen an accurate accounting of your income. So again, the matching principle. When you make money from the business, the expenses associated with it should be done in a timely manner for your financial records. The next one, historical cost principle. When you buy an asset, it is recorded at the price that you paid. Price that you paid, or the cost of that asset. So what if you bought a vehicle for your business and you got a really good deal? Maybe it was a $40,000 vehicle and you got it for $30,000. What are you going to record it on your books as? $30,000, the amount that you actually paid, or the cost of it to the business. Is that clear? Okay. It remains on the books as long as it is owned by the business, or they decide to dispose of it, and it remains at that cost. Okay? No adjustments are made for this asset in terms of the market and the changes. So for an example, a computer is bought, and we know what happens to computers as soon as we get them home. They decrease in value. It still remains on the books as the cost that we paid for that computer. Okay? Now, this brings me to something called useful life. We have different types of assets, which we'll be talking about later in the term. Long-term versus short-term. Long-term assets are those assets that will be in existence for usually more than a year. We can do something called depreciate. Depreciate means we can reduce the value of them. It is a deduction for our business. It is an expense for our business. But to do that depreciation, we have to determine the useful life for those long-term assets. So, first of all, we need to determine that period of time that that asset is expected to be of use to the company. So how are we going to determine that? Research. Yeah. See, what's the norm? What's the endurance for something like a computer? I have my own thoughts. When I buy a computer, I expect it to last about 3 years. And then, pardon, you said 8 years? Yes. And then what happens? It may still work, but usually it's so outdated and would cost you so much to upgrade that it's just better to purchase a new one. So useful life is important. It can also be a useful life depending on wear and tear. So something could actually literally wear out. Appliances now. What happens with appliances? They don't last like they used to. It's not the 25-year useful life. You're lucky if you get 5 to 10. Yeah. And again, what we're going to do is we're going to show depreciation for these assets, and that will be an expense, and that's going to be something we're going to do when we get to adjustments here in a short time. Now, depreciation expense is a new expense that we haven't dealt with yet. So because it's an expense account, what is the balance side for depreciation expense? Debits. All expenses have debit balances or increase with the debit side. Depreciation expense is the same. We're going to use one method of depreciation for this class, although there are numerous ways to depreciate an asset, and that's called the straight line method. Straight line method. So look at the formula up here for determining straight line method of depreciation. We take the original cost, and from it we subtract or minus the residual or salvage value. And what is that, residual or salvage value? Anybody know? The value that this asset may have at the end of its useful life. For example, when you buy a vehicle, it usually has a value when you go to sell it, correct? A blue book value, something like that. So at the end of its useful life, when you may no longer want to use it, it still may have some value. You may be able to sell it. Let's put it that way. It's based on that salvage value. So we're going to take the original cost, subtract the salvage value, and divide it by the years of useful life. So let's think about that. Let's say something cost us $6,000, a piece of equipment, $6,000. At the end of its useful life that we determine, it will have no value, meaning we won't get anything out of it. So we don't have to subtract anything from the $6,000. And it's going to last for 5 years. Well, if we're determining depreciation by month, and you may do that, or you may do quarters or yearly, whatever you want to do, how many months in 5 years? Good. 60 months. 5 times 12 is 60. So if we take 6,000 for the original cost and divide it by 60, what is the depreciation per month? $100. So we get to expense out $100 per month. Does that make sense? So you're reducing your asset by 100, but not directly to the asset, and we'll show you that here in a second. But you're determining what the depreciation, how much do we have to adjust that asset? And for 1 month it would be 100. For 3 months it would be 300. To do this adjustment for depreciation, we're going to have another new account called accumulated depreciation. Now, oftentimes it's called accumulated depreciation, and it also has the asset attached to it, like maybe it's accumulated depreciation for equipment. Maybe it's accumulated depreciation for a vehicle. So each asset could have its own accumulated depreciation account attached to it. Now, this accumulated depreciation account is called a contra account. Contra means opposite. So it's going to have the opposite balance of the asset. So assets have what type of balances? Debits. So the contra account called accumulated depreciation would have credit balances. So let's think about that. If we're going to record depreciation expense, that would be a debit, correct? So we would debit depreciation expense, and what do you think we're going to credit? The contra account called accumulated depreciation. So that would be a credit, which makes sense. Opposite of an asset would be a credit. So for example, look here. Word processing equipment shows a $6,000 balance, less its accumulated depreciation of 80. What's the value for that word processing equipment? Yeah, you can read. $59.20. So you take what's in the accumulated depreciation account or the contra account that goes along with it and subtract the balance from the original cost. Now, why not just credit the asset $80 for the depreciation? Doesn't that make more sense? It doesn't show what you've depreciated for. It just shows it reducing in value. But this way, if you have the accumulated depreciation account, you know how much you actually had to deduct for depreciation by itself. So you want to keep that as a separate account. Okay? And we're going to be working on this more, so don't worry if it's still not totally clear. Now, book value. A term. You might find it in a quiz. A book value is the book's value that we carry in our various ledger accounts. Now, it's the cost of that asset minus the accumulated depreciation. And remember, those are two separate accounts. The cost will be in the asset account, and accumulated depreciation will be the amount of depreciation we have taken on that asset. Now, as a quick review, which assets can we depreciate? Which assets can we depreciate?
Items that have value at the end of their life.
More. No. No. Equipment, or those assets that last longer than a year. So if it's a short-term asset, and what would be an example of a short-term asset? Office supplies. We expect to use up office supplies within a year, so therefore we cannot depreciate those supplies. But things like equipment that we intend to keep for longer than a year, we can depreciate. Building. Buildings can sometimes be, but usually buildings do what? Do the reverse. They'll appreciate in value, so we're not going to depreciate them. But it's possible that things like vehicles, etc., will be depreciated, because what's the advantage to depreciating things? It's a tax deduction. It becomes an expense for your revenue, against your revenue. So you have net income that is reduced, but then you pay less taxes on that.
You might be able to also saying that some companies put money into an account so then they can replace it later.
They put money into an account so they can replace it?
To depreciate, and then they put that depreciation each month into an account, so when they need to replace it, then they have the money for it.
Okay. Yes. He's talking about intro to business, talking about they'll take the amount that they depreciate an asset and have a separate account for the value of that, so that as that account depreciates, they know they need to start thinking about purchasing a new one. Purchasing a new one. Now, what we're going to do now is stop for a minute, and then we're going to come back and talk about something called worksheets.